Okay, Jess, let's talk about dividends. I get the idea of dividends. You get paid for just holding the stock. But what I don't totally get is where they're supposed to fit into my portfolio. Like, are they just for people close to retirement? Or should I be paying more attention to them now? Is there a strategy? How do dividends work?
Oh, such a great question. Most people hear dividends and think it's about collecting checks, but dividend investing is actually a smart, strategic way to build wealth at any age. It's not just for retirees. There's ways we can structure it in our portfolio.
Okay, so it's not just about the payout, it's about how that payout fits into your bigger investing picture.
Yeah, exactly. So in today's episode, let's break this all down, how dividend stocks make you money, how that differs from growth stocks, what makes a dividend stock high quality, not just high yield, important distinction, how to use key dividend dates to make sure you actually get paid, what they mean, where to find them on your brokerage firm, and why dividend stocks can help smooth out your portfolio thanks to lower beta and steady income. And we'll describe beta too.
Yeah. Yeah, this is the stuff I really want to understand, like how to move from just picking stocks to actually building something intentional.
Yeah, that's the goal. Whether you want income now or you're reinvesting for the long term, dividend investing can give you your portfolio structure, stability, and some very real growth potential.
Okay, well, let's go. I'm ready to level up my strategy, dividends and all. You're listening to MakeHer, the self-directed investing education podcast that breaks down how the stock market works in a way that actually makes sense from her perspective.
That's us. We're her. This podcast is teacher-learner style. I'm your co-host, Jessica Inskip. I act as the teacher. I've worked in the self-directed investing space for over 15 years and talk markets on CNBC, Fox Business, Yahoo Finance, the Schwab Network, and Bloomberg. So many networks, all the things. Added cheddar. Also, so many.
You're all over the place. I love it.
Yeah.
And I'm Jessie DeNuit. My job is to make sure that everything actually makes sense by stopping Jess when she gets into jargon land. And that means I'm not afraid to ask the hard questions that we're all thinking.
Yes. And together, we're on a mission to make you fen-fluent, not fen-fluenced.
What's on the agenda today for dividends?
All right. So here's what we've got lined up. First, we'll break down how stocks actually make you money, going back to a little bit of basics, whether it's through price growth or getting paid directly with a dividend, what that means. Then we'll talk about what makes a dividend stock high quality. Very important distinction. We're not just chasing yield. We're looking for consistency, sustainability, and companies that really know how to take care of their shareholders. Because you're a shareholder when you own a stock.
That's right.
Next, we will walk through the key dividend dates you have to know if you want to get paid and how to find that info on your brokerage app. So basically, you need to own it by a certain time frame. Otherwise, you don't qualify for the dividends. And finally, we'll talk about where dividends can fit into your overall investing strategy, your portfolio, whether you want income now, growth later, or just a more stable portfolio overall. Yeah. So by the end of this episode, you'll know exactly how to use dividends as a tool, not just a perk that gives you income. How does it fit into your portfolio is the key takeaway.
Okay, cool. Well, I know that people invest in stocks to make money, but I still don't fully comprehend the growth versus income/dividend strategy, I guess. So can we break that down into a super beginner-friendly explanation?
Yeah, that's such a good question. And I'm so glad you asked because this is where it really starts to click, especially for our beginner investors out there. When you buy a stock, you become a tiny owner in a company. And as an owner, there are basically two ways you can earn money from that investment. That's why we call it investing, because you're invested in the company's success. One, the company's stock price goes up. We call that capital appreciation. So if you sell it later, you make a profit. If you don't sell it, it's just an unrealized gain. Or loss, because it could go the other way. Or two, the company shares its profit with you directly by paying a dividend.
It could be both also, right?
Yes, it could.
Okay.
Absolutely. Yeah.
So dividends are basically just free money?
Yeah, kind of. Exactly. They're not, nothing's free in life, but they're your share of the company's profit. So this is the big idea. When a company earns money, it has a choice. It can either A, pay some of that money back to shareholders through a dividend. That's what the dividend is. Or B, keep the money and reinvest it to try and grow the business. Companies that pay dividends, they're usually more established, they're stable, they've already built something solid, and now they're just sharing the profits with the investors. They're not trying to growth, innovate, or something like that. But companies that don't pay dividends or have smaller dividends, they're usually focused on that growth aspect because every dividend paid to a shareholder is not reinvested back into that company. So these people, they want to use their profits to expand, maybe build new products, enter new markets, hire more people. Those are often actually growth stocks. That's the difference.
Yeah, because like we talked about blue chip stocks way back in episode 2 or 3, and some of those are probably more dividend stocks. They've been around forever, like Coca-Cola, Pepsi.
Yeah,
AT&T,
exactly.
Okay. So there's kind of a choice between getting paid now or letting the company keep growing so maybe you get paid more later.
Yeah, exactly. That's a trade-off. And it doesn't mean one is better than the other. It just really depends on your individual goals because finance is personal. So here's a super simple way for our listeners to think about it. If you want income now, maybe to help cover bills or reinvest steadily, dividends are great. If you're okay waiting and want your money to grow over time, growth stocks might make more sense. It depends on where you are in your investing journey. Are you trying to grow your nest egg or are you trying to preserve your nest egg?
Interesting. That's actually a super helpful way of looking at it. And I love that it's not just an either or. Either you can mix both into your portfolio, right?
Yeah, absolutely. And most investors do. I do. In fact, you'll often see portfolios with a mix of dividend paying stocks for steady income. I use it to smooth out volatility, which we'll talk about in a moment when it fits into your overall portfolio. Growth stocks for longer term appreciation, and maybe some index funds or ETFs to keep things diversified. And there's also income ETFs too, as well, because there's a fund for everything.
Of course. We still need to do our There's a Fund for that episode.
We do, yes. That would be fun. Just like list things, and then I'll just say there's a fund for that constantly. But the important thing is knowing how a stock generates money because that helps you make more intentional decisions.
Okay. So stocks can either pay you directly through dividends or they can use their profits to keep growing and hopefully make the stock more valuable over time. It's not just about the stock price going up, it's about what the company does with the money it makes by reinvesting it back into the company. And that totally changes how we look at investing.
Yeah, exactly.
So now we know what a dividend is and that some companies pay you just for holding their stock. But how do you actually know if a dividend is good? Like, what makes a dividend stock high quality?
I love this question, and it's such an important question because once you understand what a dividend is, the next step is learning how to spot a company that pays dividends you can count on. We want to look for consistencies. We want high quality dividends. So here's a short answer. A high quality dividend stock is one that pays a dividend consistently, sustainably, and ideally even raises it over time. So let's just break down what to look for. First, dividend yield. This tells you how much the company pays out in dividends compared to the stock's current price. So if a stock is $100 per share and it pays $4 per year, so we always look at this annually, but it may pay you quarterly, it may even pay you monthly. But in this example, if it's $4 per year, that yield is 4%. And most brokerage apps, you put in the security or the stock symbol, and then that should be right on the brokerage firm's page. This is a dividend yield, always right there.
And is 4% high?
It's average, I would say.
Okay.
Yeah, this is a good question because this is when you would want to compare it to the risk-free rate, which would be the front end of the curve. What's the difference? Should I get into this fixed income side or should I get into high quality dividends?
Oh, okay.
Mm-hmm.
Okay, so the yield is kind of like the dividend's interest rate.
Yeah, exactly.
Same thing.
Exactly.
Okay.
Mm-hmm. But there is a catch. So it's why I'm glad you asked that question because a super high dividend yield can actually be a red flag.
Oh.
Yeah, well, think about it. The math. One, if the stock dropped, that same example, if the stock goes down, it's going to have a higher yield if it's paying the same one. But why did the stock price go down? We need to think about that. That's just the math equation there. And it might mean the company's in trouble. Why is it? So we don't want to just chase the yield. We want to understand why it's high. That's important.
So would you look at like the past 12 months and then future trailing months to see what's predicted?
Yeah. So same type of thing that we do when we look for stock analysis. We're going to say, is this a good company? And then we're adding another layer saying, I want to actually invest for income, or it has a dividend. Is it still a good company? Because we want to make sure. I like going back to it. My first manager at Scottrade told me this. And I said it earlier, every time a company pays out a dividend, it's not reinvested back into the company. So it should even out at the end of the day, which in all reality, in hindsight, it doesn't. Growth stocks have a lot more upward momentum, but they're also a lot more volatile. What I'm trying to say is it's still a company when you have to make sure it's a healthy company.
Yeah.
So this is where there's additional it's not indicators, but ratios and things that we would look at on the income side.
Okay. What would we look at?
Yeah. So payout ratio is one. So it tells you how much of a company's earnings they're using to pay the dividend.
Oh, I never heard of that one before.
Yeah. So a healthy payout ratio, it's usually under 60%, meaning the company still keeps plenty of profit to reinvest and grow. So we can have a balance there. If the ratio is too high, like 90% or more, it means the dividend just might not be sustainable.
Okay, so it's like if someone gives away almost all of their paycheck every month, they might not have enough left to keep things running in their personal life, like paying their bills and things.
Yeah, exactly. So you know how we look at profit margin to see if there's a cushion for growth stocks?
Yeah.
That's kind of what we're doing here with payout ratio. Is we're kind of adding another layer to that. And what I also like to add to that is free cash flow. I want to make sure they have free cash flow that is greater than the dividend as well. That tells me that just the cash that they have on hand that they're constantly keeping, that tells me that they can pay the dividend.
Is the free cash flow the same as their profit margin?
No, it's not. It's not.
So it's like excess money they have.
It's the cash flow that they have. So like it's not exactly earnings.
Is it like the petty cash? I don't know if companies still have petty cash, but you know how they have like petty cash? Like,
oh, yeah.
I'm thinking of Don't Tell Mom the Babysitter's Dead, where she takes money out of petty cash and then like her brother finds it and takes all of the money and buys his girlfriend a ring or whatever. But like that was like just supposed to be extra like money, fluid money the company has in case of whatever.
You know what? It still works as a good example. You want to make sure that they have enough cash, period, inclusive of petty cash, to constantly pay out that dividend. Otherwise, they don't have to pay you a dividend if they don't want to. They can announce it, then pay it, and then they cannot pay it the next quarter.
That's something I forgot about. We did talk about that before. I totally forgot that it's like not a contract. You own a share of a stock. You get a benefit of the dividend when it's listed, but like that can change.
Exactly.
Yeah.
Great point. Yes.
Okay.
But this is what we're looking for. A strong business pays dividends and still has room to grow. So we can look for dividend growth. We love companies that not only pay dividends, but raise them over time. So if you see that, that's a sign that they're financially healthy and they're committed to rewarding shareholders. So if I'm an income investor and I see that they're raising their dividend, they obviously have the cash to do that. Just like they would announce a stock buyback or something like that. That tells me that they're financially stable. And there's even a special group called the Dividend Aristocrats.
Oh.
Those are S&P 500 companies that have increased their dividend for at least 25 years in a row.
Wait, where do we find those companies? Can we type that in our tool? So
there isn't a screener for Dividend Aristocrats. There should be.
Could probably Google
Use a screener to filter these, and we could come up with it. Yeah.
That's right, filtering. Now, what about beta? Can you look at the beta of a dividend stock to see how volatile it might be, and therefore maybe they will not keep paying the dividends if it's that volatile? Or you may get more dividends at some point and then less at another point.
Yeah. So beta, that's such a good point. And this is the way I use it. Actually, when the market was in turmoil, I talked about smoothing out the volatility of my portfolio in the media a lot, choosing lower beta stocks that are high quality dividends. That's what I did to my portfolio.
Let's just define beta real quick. I know you're about to. Yeah.
Okay. Yes. Thank you. No, I probably would have got into it, so I'm glad you stopped me. But bonus turn, it's a measure of the stock's volatility compared to the market being the S&P 500. So a beta of 1 means the stock moves with the market.
Because the S&P 500 is a beta of 1 always,
That's
right?
right.
Okay.
Exactly. That's the benchmark. And a beta below 1 means it's less volatile. It doesn't swing as widely. So if we want to smooth out the volatility in our portfolio, I would want a lower beta because you'd net it all out. It means that as the stock market is volatile and going up and down like crazy, if I have a lower beta security in my portfolio, I'm not going to be as affected by that volatility. Yeah. Well, and many high quality dividend stocks tend to have a lower beta, which smooths out those ups and downs in your portfolio.
So dividend stocks can help stabilize your portfolio too, not just pay you.
Exactly. It can be out of a full, well-rounded investing portfolio. They can be a steady paycheck in your investing plan. And especially when the market gets choppy, like it has been very volatile. And so you don't have to memorize all of this. This will be on your brokerage firm. But when you type in the security, you're looking for dividend yield, you're looking at payout ratio, looking at dividend history, looking at beta, and bonus, free cash flow. And if you go to the fundamentals or key stats section of the stock research page, that's where you'll see all that information.
Oh, okay. That's good to know. Didn't even think about where to look. Okay, I'm feeling way more confident about what a dividend is and how to spot a good one. But how do I actually get the dividend? Like, does it just show up in my account?
That's such a good question. And I'm really love how well-rounded today is. No, it's not automatic just because you own the stock. You have to own it at the right time. That's why knowing the dividend dates are super important. So there are 4 key ones that every dividend investor needs to know. And again, you shall see this on your brokerage firm. And if you do not, you need a new brokerage firm. So 1 is the declaration date. This is when the company says, hey, we're paying a dividend. They declare it. I declare a dividend.
I do declare a dividend.
I imagine that they do it just like that. But they announce the amount, the important dates, and who qualifies. Very famously, SPY, the passive S&P 500 index ETF. Yes, they do the declaration date like the day before. It's driving me crazy.
The day before what?
You had to own it in order to qualify.
Oh,
yeah.
Interesting.
So know that they sometimes don't even do it in advance, which it is what it is. The second is the ex-dividend date. This is the most important date here. If you buy the stock on or after the ex-dividend date, you will not get the upcoming dividend. You have to own the stock before the X date. So if the X date is today, June 24th, you need to own it on June 23rd. If you were to buy it on June 24th, you do not qualify for the dividend.
But if you buy it on June 23rd, you automatically get that dividend?
You will qualify for that dividend, and you could sell it on June 24th, and you will still get that dividend.
Oh, cool.
Yes, you do. Mm-hmm. But the stock price adjusts, so don't think you can game the system. Not a thing.
Yeah. They already thought about all that.
Oh, yeah. The next day, the stock starts trading. It trades without the dividend, as in it goes down in price, and it gets adjusted everywhere. Mm-hmm. And then the record date, this is when the company checks its list of shareholders. If your name's on the list, you're getting paid. This equates to the ex-dividend date. If you go the day before the ex-dividend date and then add settlement, you get on the record date. That's a date.
But
now you know how it works.
Two different. I guess you just need to know what the ex-dividend date is to get the dividend, and the record date is more on the company side. Like it's what they have.
Yeah, exactly.
Okay.
Yeah. Don't worry about that.
Okay.
It means it needs to be fully paid for. And technically when you buy a stock, it has a settlement period. So
yeah, that's true.
You don't need to know that, but the
But I mean,
company
depending
does.
on, we've done an order type episode. So if you put an order type, you
Mhm.
know, like for something to be bought when it hits a certain threshold or whatever it is, that could mess up your dividends potentially.
It, well, normally they actually adjust for dividends too on
Oh,
those.
I
Yeah.
didn't know that.
There's a little button you can hit. Yeah. There's the brokerage firms think of everything.
Good.
And then the last date, very important, would be the pay date. This is when the money lands in your account. It's your dividend payday, if you will.
Mm.
And again, you can buy it the day before the X date. You could sell it on the X date. And if the paydate's a month from now, you're still going to get that dividend in your account because you qualified for it.
Cool.
Mm-hmm.
So if I buy a stock the day before the ex dividend date, I get that payout. But if I wait one more day, I miss the dividend completely. Okay.
The difference is everything. So if dividends are part of your plan, you'll want to check the X dividend date before buying. That's the important one. Most brokerage apps will show this info in the stock's profile page. You'll see the word dividend, you'll see the dividend yield, and then you'll see these dates. It might be under company events or earnings plus dividends, something like that. It might even be a little calendar icon, but it's there.
Okay. Now, how do dividends fit into my portfolio?
So now that we know how dividends work and how to track them, we definitely need to talk about how they make sense in your portfolio.
Yeah.
Love this. Yes. So dividends are especially helpful if you want steady income to cover expenses, reinvest, or just feel more financially grounded. 2, if you want to smooth out the ride because we're on a roller coaster, and if we want a less volatile roller coaster because dividend stocks, they tend to be less volatile. Or if you're focused on long-term wealth building and like the idea of earning while holding, and it's all up to you. But you don't have to spend your dividends. You can set up something called DRIP, which is a dividend reinvestment plan, which automatically uses your dividends to buy more shares, and that's compounding in action.
Oh, that's cool.
Mm-hmm.
Does every brokerage firm have the drip? Is that a feature?
It is a feature, and not all of them have it.
Check
Not
to
all
see
of them have it.
when you're figuring out which brokerage firm you want. If this is important to you, you're going to be doing dividend investing. Okay.
Yeah.
So even if I'm not retiring anytime soon, dividends can still help me build wealth, like kind of quietly in the background.
Yep. And that's the magic. So whether you want to live off that income later or just reinvest it now, dividends can be a really strategic part of your overall plan. And again, I use them to smooth out volatility in my portfolio. When I think the market is in turmoil, I start adding a little more low beta securities to my portfolio. That's what I personally do.
It's a good tactic. And with the DRIP, dividend reinvestment, so it's a feature you turn on. Does it automatically reinvest into the same dividend stock, or can you reinvest that dividend anywhere?
Usually the same dividend stock.
Okay.
That's a good question. But the important takeaway, one, how it fits into your portfolio, high quality dividend stocks are important. High quality. Just because it has a high yield does not mean that it's a good stock. It's a red flag. They're trying to get your attention for a reason, trying to get investors for a reason.
Yeah.
You want to make sure it's financially sound.
They probably need your money for a reason.
Yeah.
Yeah. Also, another note, though, if you do not do DRIP, like the dividend reinvestment feature, then it's probably just going into the money market account you have at your brokerage firm, right?
Yep, exactly. And taxes, they're taxed differently. It's taxed as income.
Taxed as income.
Unless it's in your retirement account.
Oh.
Then it's not taxed at all.
Okay. So if that money is going into a money market and it's not in some sort of DRIP feature, make sure you're either doing something with that, whether you're withdrawing it or whatever you want to handle that tax-wise, or if you want to manually reinvest it, you have to do that. Go buy things yourself with that money. Don't forget that. Don't just leave it sitting there if that's not your goal with it. So have a plan, have a goal.
Always.
Okay. To wrap up today's very educational episode on dividends, we learned that dividends aren't just about collecting cash. They're about being smart with timing, knowing your strategy, and using tools that help your money grow. I learned that owning a dividend stock on the wrong day means no payout, which we don't want. But if I pay attention to the X date and set up reinvestment, I can turn those payouts into long-term growth. This makes dividends feel like a real tool we can all use, not just a nice little surprise.
Oh, yes. Beautiful.
Strategy.
As a tool. Yes. Be strategic and calculated. If you learned something today, share it with your family, your friends, your fam, even your frenemies.
Your ups.
Your ups. I like it.
And leave us a review if you feel so inclined, or you can buy some of our funny finance merch on our website at shop.marketmakerpodcast.com. Just to help support our cause for free financial literacy on this podcast.
We would like to make an income off of this at some point, but we also don't want to exploit you. So help us
Help you.
keep our values aligned.
Help us help you.
Yes. And remember, when you build knowledge,
You break down more barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. MakeHer provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by MakeHer on our website or podcast is not intended to be a substitute for professional financial advice. MakeHer is not liable for any investment decisions made based on our content.